If you want to control and standardize a global economy, you need a single, overarching metric to tell you how well the system is running. For decades, the architects of our financial systems have relied on one specific number to declare a society successful. That official metric is real GDP per head. In macroeconomic terms, this is the primary indicator used to calculate a country's material standard of living, measuring the average economic output available to each person. To understand how the calculation works, we have to deconstruct it. We start with the word real. Nominal GDP simply measures total output using current prices. But as this photograph from Venezuela shows, hyperinflation can make millions of nominal currency virtually worthless. By adjusting the data for inflation, real GDP reveals the actual purchasing power of an economy. Then we apply the per head or per capita adjustment. A country like China has a massive total GDP, but it also has over 1 billion people to support. To find a meaningful average for the standard of living, the system divides the total economic output by the size of the population. According to the official algorithm, a rising real GDP per head means the economy is thriving and citizens are wealthier. The math is clean, logical, and universally accepted. But it is also an illusion. When you compare the official data against the lived reality of the population, massive anomalies start to appear. High real GDP per head frequently contradicts the actual conditions on the ground. The first major glitch is income distribution. Because real GDP per head is strictly an average, it can easily mask severe wealth inequality. In a country where a tiny percentage of the population controls the vast majority of the wealth, the average output looks incredibly high, even if the majority of citizens, like many in this South African street scene, see very little of that money. The second glitch comes from negative externalities. GDP tallies up the total value of manufactured goods and services. It completely ignores the environmental damage, the carbon emissions, and the deteriorating working conditions required to produce those goods. Finally, the system has a massive blind spot, the informal economy. Millions of people operate in cash-based, localized markets, like the ones represented by the individual sitting near this market wall. Because these transactions are undeclared, they go entirely unrecorded by official national accounting. Real GDP per head excels at measuring the average output of the formal material economy. By design, it is completely blind to actual human quality of life. The United Nations recognized these flaws and developed an alternative metric to measure actual human progress, the Human Development Index, or HDI. This graphic represents the structure of the HDI. Instead of relying on a single economic data point, it is a composite indicator. It combines 3 specific dimensions of human life to output a final score between 0 and 1. The first dimension is income, but instead of a simple average, it uses gross national income per capita, adjusted or purchasing power parity. This PPP adjustment accounts for the actual cost of living differences between countries to determine a truly decent standard of living. The second dimension is healthcare. This is measured quantitatively by calculating life expectancy at birth, capturing the physical well-being of the population. The third dimension is education. The index measures both the mean years of schooling adults have received and the expected years of schooling for children. By moving beyond pure purchasing power, the HDI attempts to measure what humans can actually do and be within their society. To see how this changes our view of the world, we can run a comparative case study. Look at Qatar. It possesses a massive GDP per capita, driven by vast natural resource wealth. Contrast that with Cuba, a nation with a significantly lower GDP per capita and limited access to global consumer goods. This chart compares their global rankings. When we look strictly at GDP per capita, Qatar sits near the top of the world, while Cuba trails far behind. But when the HDI scanner is applied, the gap drastically narrows. Cuba's ranking jumps significantly higher than its income would suggest, while Qatar's HDI rank drops well below its economic rank. The data shows exactly why this happens. A country can offset a lower material income through heavy, deliberate state investment in public healthcare and education, raising the life expectancy and literacy rates of its population far above its raw economic output. Economic growth increases total resources, but it does not automatically equal human development. How a government chooses to invest those resources makes the difference. Even with its upgrades, the HDI algorithm has its own blind spots. It is a better tool, but it is not a perfect simulation of reality. First, it misses crucial qualitative factors. A country can have high income, good schools, and modern hospitals, while simultaneously suppressing political freedom, human rights, and gender inequality. HDI ignores these social realities entirely. Second, it shares GDP's environmental blind spot. The index does not penalize countries for resource depletion or ecological destruction caused by their economic growth. Finally, HDI is still an average. It can easily fail to capture deep inequalities within a specific country, masking the difference between wealthy urban centers and neglected rural areas. Composite indicators provide a much clearer picture of human society than raw income alone, but no single number will ever capture the full complexity of a nation. These flaws in the economic metrics are exactly what IGCSE examiners use to build their most difficult questions. Scoring well requires you to look specifically for these data anomalies. First rule: never confuse nominal GDP with real GDP. If a question asks about measuring living standards over time, you must explicitly state that real GDP accounts for inflation, while nominal GDP does not. Look at this official Cambridge mark scheme. Examiners award marks for identifying exceptions to normal data trends. If a country has high GDP but high poverty, you must explain why. Explicitly write that it suffers from uneven income distribution or low tax revenue investment. Economic indicators are just tools to read the code. To truly understand a country's standard of living and to secure your grade, you must always look at the human reality hiding behind the data.